Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. One p.m. on the East Coast, Swizzle here. That, of course, is the great Carter Worth. Never have seen you in red, reminiscent of
red. I'm not quite sure why I put it on.
Berg song. Are you familiar with that Krista Berg song? Yes or no?
No.
Now, that would be, of course, Lady in Red, although you are far from a lady. You are a stud, so it's great to have you. Dan Nathan is in, if I'm allowed to say this, am I dexing him or something? Well, he's in California, so good for him. But this is Market Call, 1 o'clock on the East Coast, as I mentioned. A lot going on today, Carter, so we're going to throw the rundown up real fast because sequencing is everything, and you're the master of that. How low will crude go? I mean, holy cannoli, as they say. Chart checks on banks, which are having a day, albeit down, and the JPM trade update that Dan talked about. And we'll talk about a few other things, and if we have time, some questions. So let's get right into it, Carter, because there are things happening today. Goldman says, watch out for more drawdowns, but the risk of a bear market is still low. I'm not exactly sure what that means, but that's our first slide of the day. Yeah,
that's a funny one. What does that mean? Markets will have repeated and regular sell-offs, but don't worry about it because it won't ever amount to a bear market. You know, that's a tough one. That's the kind of language of Wall Street that you want to try to avoid. Yeah.
The alarmist, but don't want to be an alarmist. But look, I get it. I'll say this real quick. With the VIX, again, I think today it's trading 20-ish. And, you know, we have bounced off. I think we got back down to about 15.5, 16 after that August 5th day. But I'll say this, and I'm not necessarily asking you to comment, but, you know, I think the VIX is getting ready for round two. So we'll see. But let's go to your sequencing charts real quick because I find this to be fascinating. Again, money in motion with the great Carter Worth.
Right. So what the attempt was just to put in context in very plain language the events of the past 12 months in terms of the chart, in terms of price action of the S&P 500. So here it is in language form. Let's put this language into the charts. And so here is a 1 year weekly bar chart. Color code is straightforward. And you see there it says on the upper left, no lines or arrows drawn, no judgment rendered. Obviously, red is down, green is up, weekly bars. And so let's put the first, we know, we can flash that. Let's take it on, take it off. We know that was a mature intermediate advance. Intermediate, they're minor, intermediate, major moves. This is a 9-month move, and it is up 38%. So that's the first part of what has been the past 12 months. Next part of the sequence, a break in trend. Let's flash that. A break in trend. We broke trend and we had a concomitant 9.7% sell-off. These are just the facts as they stand and what's in that movie. And they're incontestable, right? Or uncontestable.
And those facts are right. Uncontestable. Now, let me stop you there for 1 second because I just want to interject quickly. You know what we've been talking about, and we've drawn similar lines, although your lines are always better. But what I've thought, and I think you would probably agree, because I think you have agreed, what we saw in March and April that moved to the trend line effectively, and then the subsequent bounce. The bounce took place over the course of a few months, and it was just very orderly move. The break in trend this time got us down to that August 5th low, and you said 9.7% sell-off. But the subsequent rally all it did was get us back to that trend line again. So what was support becomes resistance. And what I was postulating is, although it felt good to be long, that might actually be the worst thing in terms of the speed with which we got there. Please continue.
Right. So the third part of the sequence, so we put that in, is the ricochet. And you see that here. And we move up to the trend line, which we breached. And of course, the fourth part of the sequence, what do? We fail there. You can see it in the next chart as annotated, a failure at the trend line, and we make a lower high. Let's keep going. The sequence continues. It's also a double top. And so where from here? Some people say, well, higher. We think lower, further downside as written in the chart from the report. for clients. How much prospective downside? Reference point number one. Let's flash that on and off. The August 5th low. Okay. Or of course, the April 19th low. Put them all together, all the charts together. This is what. Now, were you to get down to that April 19th low, we would have a sell-off that's getting close to about 11% from the peak, 12% from the peak, and that would be perfectly reasonable. It happen all the time in markets. It's very rare nowadays, but more to come by my work.
And I want to just go back to the original one that's just text, the S&PX sequencing, just so people can read it for themselves quickly, because, visually you gave it to them, but here it is just in terms of, the work in the written form. And, I think it's one thing to read it and try to sort of analyze it from there. And then subsequent to that, to look at it the way you sort of measured it out or sort of spelled it out in the form of charts, I think is really interesting. So I'm with you on this one, and we can put up a real-time look at the S&P 500 if you want, Amanda, because what I've thought for a while is, again, the magnitude, the speed with which we got back was great if you were long, but concerning with the speed with which we got there, and the fact that we couldn't take out those prior highs. I think it's interesting. There's the 150-day moving average, something that we've basically taken. We are now taking the lead that you gave us, and that's what we're implementing from here on in. You could see the breach on August 5th, albeit brief. It's seemingly absolutely in play, and one has to ask themselves, what happens if and when we get there? And this 150-day, Carter, that's been steady climb, I'm not saying it's flattening out, because that's not what's happening, but at a certain point with sideways action, that's exactly what's going to happen. We're going to start to flatten out and potentially start to roll. Thoughts on that?
Yeah, it's time and price, and you try to figure out where we're headed. The constituents, we know right now the S&P is up 14.5% for the year, but 48% of the stocks in the index, basically half, are down on the year. Index up 14.5%, half the stocks, 48% anyway, down, and 33%, a third of all stocks are down 10% or more. So we still have the problem of a few big names driving everything, and that's the real risk, because some of those big names are under real pressure. Microsoft, Google, so forth. Exactly.
And I'm going to interject here a couple questions. C.R. Taylor is asking, and this is a great question. Oxy cracked the $55, $56 level and heading south of where the Buffett backstop seems to be. What's the chart say? So there's Oxy there. Let's do a longer term chart of Oxy, which is amazing to me, Carter, since Buffett announced his stake in this company. And historically, seemingly when he announces stakes and things, they typically go up and are unabated to the upside. In this case, it has been sideways effectively for the last 2 years, which I'm not sure what that means. I guess it means there's a lack of relative strength, and despite the fact that somebody of his magnitude is in. To answer your question, C.R. Taylor, I think it's just a matter of time before Warren Buffett takes this entire thing over. But with that said, and I'm not trying to be glib here, I have no idea what that means for the stock, because if you look at this is clearly not particularly bullish formation. Thoughts, Carter?
Yeah, it's defaulted here to a log. If we could put it to an arithmetic chart, you'll see how wide-ranging the sideways action has been. And so what we know is it's basically between 50 and 70, huge, and we're now undercutting all of those intermediate lows. To my eye, it's a quick swoosh to 40.
Looks that way, and it, again, remarkable given the fact that I think has now a 31% stake in the company. Don't at me if I'm off by 1% or 2. All right, which that takes us next to crude oil, which you've been really amazing on this, as has Dan. Me, not so much, but this pennant formation that we've been making now for the last 3 years or so, with the wide ranges getting less and less wide or more and more narrow, we're coming to the point in this pennant formation where something's got to give, and your work suggests it gives to the downside.
Right. So the report sent out today is just a follow-up from the August 21st report. That report was titled, "We think we're headed lower here. A break to the downside is judged likely." And so what you see on the screen is the chart as depicted in the report to clients at the time. And of course, we can see now where it is. If we do a then and now, we have broken, and we've broken hard. And so the question is, okay, and I've had a lot of incoming institutional calls today on this very subject. It's the reason we sent out the follow-up. Sure, a very short-term tactical player could say it's pretty oversold. I think I want to cover here. I've been short. I've been paid. I got a 10, 12% move. Of course, I'm doing the futures, so I've got the leverage. It's a huge hit. I'm up 60, 80%. I understand that. But the real message is something is wrong, right? If this were an operating company that sells sushi or sneakers or soda, we would say, what's wrong? They must make. So generally speaking, this dovetails with lower rates, lower dollar, and lower ultimately Main Street, some sort of form of economic contraction, or whatever word one chooses. And so my bias to the downside, all with the big asterisk that, sure, if you're a very short-term player, you'd say, hey, maybe we cover, maybe we reduce the short. But something is not right. It's a major break. And just remember, 3-4 weeks ago, all sorts of reports on Wall Street about how we're going to 90.
Doesn't look like that now. And when you see a move of this magnitude, I mean, this is a $3 and change move on a commodity that's been underperforming. The question, I think the bulls in the equity world will say, well, lower energy prices are going to be a complete tailwind for the consumer. And, I've heard that argument before. But what I think, although that's probably true on the margins, I think what's more true and probably carries more weight is, why is crude here? And is it because you're seeing this global slowdown? I mean, without question, a lot of this has to do with what's going on in China, but more so, I think, some of the data we've seen here in the United States. So although that will prove, well, maybe the headwind that has been there for the consumer has been abated and maybe, again, creates a bit of a tailwind, I think the overriding factor here is something else is going on, to your point. Quickly throw up an OIH. We're at 265 or so, levels we probably haven't seen since, I don't know, last spring. I mean, it's amazing how great this thing can look one week and how horrible it can look the next. And, one has to ask themselves, what's going on here? Are we going to overshoot to the downside? I do think there should be support somewhere between 250 and 255, Amanda, if you want to sort of throw a horizontal line there. That had been a prior top, so you can see what I'm looking at. That's probably makes a little bit of sense, but man, oh man, oil services does not trade well at all. And, this is something you've talked about as well, Carter.
Yeah, this is the beta trade within the energy complex. The big integrateds like Exxon offer a different proposition, right, with their yields and their sort of steadier operating businesses. But in terms of crude, just maybe quickly going back to the chart that we had up before, the truth is that we've been range bound, right, for a better part of 3 years. The spike for the Ukraine invasion, I'd point out also right there, when we hit 140, Wall Street said 250, even the mighty JP Morgan, even Jamie Dimon himself. It's not about calling people out. It's about whenever you hear someone being quite emphatic about something that's already moving more, go the other way. So wipe that out with your eye, because it's a white background. Highs for the past 3 years are 90. Lows for the past 3 years essentially are 65. It's where we are now. And one could make the case, and I'm sure others, that we hold the low. But basically, we've been range bound between 65 and 90 a barrel. We're at the low end of that range. Breaking here would be very important in terms of what it says about the global economy, what it says about China. And then the second derivative, okay, is it a sort of a tailwind for the consumer? To some extent, but as of now, it can't be, because it's just at the bottom of range it's been in, 90 to 65, 65 to 90, 90 to 65. The consumer has been dealing with this for 3 years.
I agree with that. Now, Doug Pass just emailed me, and I was going to go here anyway, but since you brought up more of an economic situation, I agree with that. And one has to wonder what's going to happen to the small caps. Now, the Russell is measured through the IWM. We're right back down to, if you look at it, around 206 or so. If you recall, this had been resistance on the upside for quite some time. So past resistance theoretically should become support here. But I think that has, what we've seen over the last couple months, to me at least, has all the makings of a what appeared to be a bit of a false breakout. So we'll see how this plays out. We're at critical support here, as you can see, with the 150-day moving average. But if things are slowing down the way I think they are, and if banks are a big component of the IWM, especially small and regional banks, you see what's going to happen there. We're going to talk about that in a second. It stands to reason that the IWM is going to fall under significant pressure. I just bring it up just to bring it up, Carter.
Yeah, sell off a dip here to a level of considerable support, all the trading going back since February. More of a pair of twos than anything else. I would think it would take a lot for this to start to break hard and in turn bounce again. We just bounced, so you don't typically get a second bounce that quickly. It probably is where it belongs.
Agree. Next, gold, which is showing again, I think just the relative strength and the fact that it can bounce back from pretty dramatic sell-offs, specifically what we saw on August 5th, is very encouraging to me. And I know you have a gold chart here.
Yeah, this is just a proper hold, right? Stay long, be long. It's an excellent circumstance. It's an excellent setup, and it's a classic what's not to like. It doesn't, it hasn't moved that much. It's an under-owned asset. It's not a popular asset. There's only one gold stock in the S&P 500, Newmont Mining. All the stocks in the Philadelphia Gold and Silver Index maybe add up to, 500 billion, one JP Morgan, so forth and so on. And I think one thing that we've heard as not a charge against gold, but a perspective issue for gold is that there's this thing called Bitcoin. It's a store of value and it's a safe haven. Bitcoin can be whatever it is, but it's not those two things. Okay, so Bitcoin has got double the volatility of the semiconductor index of late. It is sold off with the market, is bounced with the market. It can be a perfectly valid thing, but Bitcoin is not digital gold. It is what it is. It's Bitcoin, but it has not exhibited any of the characteristics of being defensive. Its correlation with other risk assets in the equity complex very high. So this is neither a bullish or bearish comment or judgment about Bitcoin, other than to say, with the spike in volatility in the VIX to almost record levels, with the current drawdown in big names, the beloved names in Magnificent Seven, Bitcoin is simply behaving closer to a stock than it is to gold. So gold is free of that charge, if you will, free of the burden that, hey, you can have another thing called digital gold. Gold is gold. Everything else is something else.
I agree with that. Quickly, man, if you want to throw up a 5 or 6 year chart of Agnico Eagle Mines, that comes out AEM. That's been one of the better performing mining stocks. You'll see that we're up against levels that we last saw in the fall of 2020. So this is pretty critical to me, at least, in terms of, what's going to happen here. Seemingly, we've stalled. We'll see if that lasts. If you do a longer term chart, I think it gives you an illustration as potentially what could happen here. I think we're going to take those levels out at some point, but maybe we have to sort of do a back and fill in the meantime. I don't know, but this is what I've been talking about for a while in terms of the mining stocks. I think the miners still have some room to the upside. We teased it in terms of the IWM, but the banks obviously are not performing. So let's go to the KBW Bank Index, which comes out BKX.
Yeah, so obviously an index of large banks dominated by JP Morgan, the biggest weight at over 10%. And so we have here in this time frame capturing all the key events of the past 2.5, 3 years. The regional bank crisis and that plunge in March, the beautiful double bottom, the ricochet this time a year ago in September, October, the climb to the former high from which the sort of the regional bank crisis began. So let's show those levels and flash it. Basically, it's why levels are so important on any chart. And those levels, are those PE levels? They're not. Are those levels of price to book, price to tangible book? They're not. Are those levels where Jamie Dimon spoke or the Federal Reserve spoke? They're not. They're just levels. Levels matter. Charts matter. Let's put the next line in. And so do we go to the August 5th low? We might have another here, which is we've shown we've broken trend, or we're about to break trend. But either way, I think that one has to assume we filled the gap of mid month a month ago, that we're going lower. And so this is an issue because just again, 8, 9, 10 weeks ago, it was buy banks. You can look it up. Every major broker dealer, banks. No.
All right, I'm going to say something. I'm curious as to your thoughts. If you look, you've outlined those double bottoms in the blue, all taking place in the year of 2023. I think one was probably April. The other was probably, I don't know, October, maybe November. And you can see those lows. You saw what happened off those double lows. The bounce that we saw was significant. The double tops, but quite frankly, going back to 2022 and again recently, I mean, the duration is obviously a lot longer. And if the double bottoms created a price movement to the upside like we saw, it's safe to surmise these double tops could potentially create the same type of outcome. So, I look at a sort of a 50% retracement of this, and I think 90 or so makes a lot of sense. We'll see, in fact, if that happens. But I think your point is well taken in terms of, all the optimism around banks recently was probably the bell ringing, at least for the short term, that we've seen in a while. JP Morgan's share slide, as Pinto says, analysts are too optimistic. I'm not quite sure who Pinto is. It was a shitty car, but whoever he or she is, I agree. And I think that sort of echoes what you just said. We're right at the 150-day. Last time we saw this again, like many things, was August 5th. Jamie Dimon has been pretty vocal about, the relative expensiveness of his stock vis-a-vis historical norms. And I think it's playing out now to a certain extent. People are concerned about some of the things that are going on there. So here we are right at the 150-day. We don't need to necessarily opine on JP Morgan, but quite frankly, as JP Morgan goes historically, so does the rest of the space, Carter.
Yeah, this is the big one. This is it's the biggest. It has in principle the best financials, best balance sheet, has the best, some people just bet in management. It's called bet the jockey. It has the best manager, obviously in Jamie Dimon. And today is a very serious sell-off. So the question is, is it contained to just one day? Does this thing stop here? Not likely. That's a big re-rating lower. And so I would take measures. If one is long JP Morgan, I would reduce. I'd sell calls. I'd put on a risk reversal. I would do something. I wouldn't just sit around and watch this unfold.
Well done. By the way, Flavian Pratt at Saratoga was the jockey to bet on, but this leads us to a trade update that we did on September 3rd. September 3rd, Dan Nathan was with JP Morgan trading basically $222. By the September 220-205 put spread, the all-in cost was about $2.50, and we talked about it. And as it turned out, the timing could not have been better. He's saying now today I would close the trade and move on. With JP Morgan basically at these current levels, put spreads worth about $12.50. You can do the math, 5 times the premium paid. In hindsight, this original trade as a spread was costly, but I'd expect the stock to have the dramatic move in a short period of time. It sure beats getting a sharp stick in the eye, though, which is always true. And, this goes back to sometimes when you're that right that fast, the knee-jerk reaction is, holy shit, you got to do something here. And I agree with Dan. Probably trading out of it makes a lot of sense. But, hindsight's 2020, I get it. But a lot of times we talk about legging into these things. So, buying the 220 and then waiting on the 205 would have been a great call. But again, that's just sort of Monday morning quarterback stuff. But we wanted to update that trade. By the way, Ally, ALLY, again, CFO flags consumer stress. Now, this is not to talk about Ally necessarily, Carter, but this sort of, again, is part of a narrative, part of a mosaic that we've been talking about for a while. Retailers, banks, across a swath of industries, they've been talking about a slowdown and the stress on the consumer. And at least today, it's manifesting itself in this stock. So we don't need to get bogged down in this, but again, when you hear it from one, okay, you don't make a big deal of it. But when you hear from a number of different companies and a number of different industries, I think it's something to absolutely look at.
Yeah, I mean, that's just the definition of bad price action, a heavy volume drop in gap, news related. And the temptation to always think, oh man, this is a buying opportunity. It's cheap. I can catch this for a bounce. Perfectly valid if you want to do it. It's just outright speculation. And sometimes it works handsomely. But there's no technique over time that argues for buying extreme weakness on the first day, on the second day, even a week later. Let the dust settle. In principle, the first matter of business is, if one's long, do you take measures even here, right? It's hard to sell something that one has just bought. How about 4 weeks ago, you paid 42? Very hard mentally to sell it now at 32. But first loss, best loss, just walk away.
Ford's been the same price for, I think, 4 decades, but we'll throw a quick Ford chart up just for illustration. So that's that. The more interesting of the two, quickly, Carter, I think, is General Motors, which, once again, looked like it was going to go. We stopped out at the levels that we saw probably earlier this summer. If you do a longer-term chart, you'll see, the stock's had a decent little run here, but, seemingly running out of steam right at the moving average. Let's see what happens here. My sense is you're going to think this is a bit of a pair of twos, and it probably is, given the context of where we've been over the last 4 or 5 years. But I think we're pretty critical support here. So we'll see how GM plays. Thoughts on that quickly?
Yeah, a very heavy down day. And so a problem. And also, the big kahuna is Toyota, right? If you pull up a chart of Toyota, if we can look at that, Toyota has lost, I believe, some 40% of its value in this recent period. And that says a lot. Autos in general, I think, are a bad space.
Oracle's a name that you've liked. I've talked about it. For those playing our home game, it was the O in my hope trade a few years ago. It also is the answer to a question that Ramesh B. has. How long, in your opinion, should Oracle upward trend last when there is no resistance? There is no resistance, I think, as we're making all-time highs. If Amanda can put up a longer-term chart, you'll see this in full effect. I think what basically happens is you can have a pretty big volume day today in Oracle. You obviously have this gap higher. I don't think this is going to be an unabated move to the upside. I do think, Carter, at some point you're going to get a better entry point. But I mean, old tech is now new tech. And I think the Oracle quarter and the subsequent relationship that they announced with Amazon has really gotten a lot of people jazzed.
Yeah, we put out a note to buy Oracle happily on Thursday of last week, and we put out a note today saying, look, it's we would harvest at a minimum for new money. We put on a strangle. There are people think it's going to keep gapping up. That's not how it works. Sell some calls. The people think this is a fake. Give it all back. Not likely. It just got re-rated here for a reason. Their earnings, and so it's been very volatile. And I would bet against volatility now. But if one is just a standard long-only player, which is great, 99% of all capital is, I would either sell calls or trim my Oracle.
Real quick, in the last minute we have, we got a question from, I believe it's Ethan Lip on HYG. I think HYG, the last I looked, is trading about 79 or so. I will tell you, the HYG has not been a story now for quite some time. People seem pretty I don't know, not concerned at all about what's going on the credit front. If you go even longer term, you'll see, I mean, outside of a couple moves to the downside, the HYG has not been a story at all. Personally, I do think credit's going to be a story at some point. I think it's something you should watch. But in terms of what we're seeing in the here and now, Carter, I don't think there's a lot either way in the HYG.
I would say that's right. It's sort of what a hold really means. So just a standard 1-year chart. A good pattern, stick with it, and more interesting really than the market here. The question is ultimately, if there is, let's say, trouble coming on Main Street, some sort of setback, whether you call it a recession or you call it a bear market for the stock market, is there a credit problem, as you've implied, Guy? Ultimately, those two things go hand in hand. But for now, credit acts well.
When you mentioned trouble, I will say, that notion just crossed my mind. What else crossed my mind was trade ideas. Get them in your inbox. Sign up today, riskreversal.com. Why wouldn't you? market matrix, which I believe, Amanda, we're in now week 18 or so. I might be off by a week. Don't at me if I am. And of course, I don't know if we have the Carter Braxton Worth slide handy, but throw that up for Worth charting, because if you're not, why wouldn't you be? Old-fashioned technical analysis, nothing slick, just charts. Sign up for that. CBW, I promise to get you out at 1:30. It is 1:30. Thank you for your time, folks. Thank you. We'll be back tomorrow. I don't know who I'm with, because I think EYT is also in California. Maybe it's Danny Moses. Who knows? But for certain, I will be here. Thanks, everyone, and thank you, Carter.
All right. Bye.